Will Jerome Powell regret saying he doesn't see the stag or the deflation? Folks, we saw a pretty significant reduction in Q1 GDP. We've seen GDP now significantly reduce for Q2. Looks like growth is slowing. And of course, we had inflation readings prove to be ever sticky. We're going to talk about inflation, deflation, disinflation, stagflation, all of this with the one and only great Mr. Dan Bird. How you doing, sir?
I'm doing well. How are you?
I'm doing well, man. So what do you got here? What are we talking about first?
Well, how do you define stagflation?
Stagflation is it's generically defined is growth below trend, think less than 1%, and it is high inflation, think 3% or higher could get you to stagflation. Generally speaking, you will also see a weakening a weakening jobs market, but not necessary. You can have stagflation with 0.5% growth and 3% inflation. Why? Because when you do the math and you take nominal and convert it to real, you actually have negative growth. So that is stagflation.
Mm-hmm. Yeah, I don't disagree with that. It's rare for that to happen usually.
Correct.
So we'll see, but we're heading that direction.
We are flirting with it right now.
and based on the definition, logically you would think, well, you will have stagflation on the way to lower inflation.
You could,
right?
Yeah, you could.
So the question then is, how long will that stagflation last? It's not so much that we will have it; it's how long.
Yeah, to be clear,
persistent.
Yeah, persistent. Stagflation would have to occur over a 3, 4, 5 quarter. It's not a transitionary call. It would be
right.
It'd be persistent. Think 3 quarters or greater.
Yeah, exactly. Right. And that really is the key.
Mm-hmm. Correct.
So now let me share my screen, and I'm going to we'll talk about the jobs number because we didn't talk about it on the last video, but we'll talk about it this time since it's coming up next Friday. And it's kind of part of this conversation as well. So for those interested in my newsletter, go to breakpointtrading.net and you can get the free newsletter right there. Let me go. I'm going to go to the charts page and we'll look at unemployment rate. So here's the one that we are watching. And this is the one I believe the Fed is watching also. And I think this will be the key to whether the Fed cuts or not. It has been slowly rising, went from 3.5 to 3.7 to 3.8 to 3.9. I suspect it probably is going to rise again.
This month?
Next Friday.
Oh, you think we'll print 4?
We might print 4. It could be 3.9 again. Could just stay there. I don't think it's going to go down.
No, it's not going down.
But this is the SOM rule, which was an ex-Fed president or a governor or whatever. And this is basically, I just went along with this rule and put in the numbers here. So right now it's at 3.74 and you add 5.5%, 0.5 points.
Yep.
And you get 4, but roughly 4.25.
Correct.
So 4.25 is when recessions start, right? So we're a good ways away from that right now. However, what you'll notice is that once unemployment begins, it spikes very quickly.
Yeah, that's the thing that I want people to realize. Unemployment takes the elevator up.
Right.
Stairs.
Fast. Right now we're on the stairs. We're not even on an escalator. We're not even on the escalator.
Correct. Stairs. Yep. Correct.
But once we get on the escalator, we very quickly transition to the elevator.
Correct.
And it goes up, and that's when recessions happen. Usually about 6 months before. 6 months when this crosses. It's already crossed over here, by the way. So, but it takes a little while before the recession, this actually starts to accelerate, and then the recession occurs. So that, I think, is what the Fed's watching.
I agree.
The panel at the bottom shows the rate of change for the unemployment rate. And the dashed line is the 0 line.
Got it.
So we're above 0 right now, which we haven't really been other than the pandemic period. I mean, even through all of this period back here to 2010, back to the financial crisis, basically, after that ended, we basically were we're below the zero line, just kind of touching it, going back down. We are now really for the first time since the pandemic above the zero line. So something to watch. It's one of my 3 recession watches. None of them have triggered yet.
Now, the Psalm rules one I brought up 9 months ago is the one that I was watching at the time. For me, it's always been 4.2. Looks like the Psalm rule might move to 4.3, but that's the number that breaks for the Fed. Like if we spike to
that's
that,
right. And remember what the Psalm rule says is recessions start when these things happen.
Correct.
So right now it's at 4.25. That means the recession starts as soon as it gets there. The Fed wants to do something before that happens. Ideally. So 4.2 is probably the right number. Even if this gets to 4.3, 4.2 is probably still the right number.
Yeah, they would like to be proactive. That's fair.
Right, because this is when it starts. They're going to do something before that happens.
Okay.
So let's talk about inflation versus deflation, because that's sort of, the stagflation is sort of the middle ground between those two. Kind of don't have one or the other. And I think in general, we would all agree that deflation is probably more concerning than inflation.
Well, let's have that discussion, because I think most people hear you saying that would violently disagree with you.
Okay.
But and again, I'm not saying they're right. I'm just saying that the average person watching this going, you're full of blank. I would much rather have deflation than inflation. Do you not see the price of eggs? Do you not see the price of milk? Do you not see rent? Blah, blah, blah. And again, I believe if you look at it over a short duration, deflation is net positive to consumers.
Yes.
Short being 3 months or less.
Yes.
Problem that people,
we had deflation in 2009. We had deflation.
And I would ask you, what happened to the job market? The job market was horrible.
Right.
Deflation over an extended period of time, meaning 6 months or longer, is horrible for consumers because most consumers are employed. When companies sell less and profit goes down, they lay people off, and it's a nasty recursive loop.
That's right.
The people that are hoping for long-term deflation, be careful what you wish for.
And why is it a recurring loop?
Because again, you have to cut overhead, which the largest part of overhead is.
Yeah, but even before that, let's go back to the demand side of it. If we're in deflation, especially if it's extended, and people feel that it's going to be here for a while.
Yeah, they wait. They don't buy.
They don't buy anything. I'm not buying that car. It's going to be cheaper next month. Yeah, I'm not buying that new TV. It's going to be cheaper next month.
Look at Tesla. Tesla keeps cutting the prices. People keep waiting.
That's right. Exactly. That's the problem.
Yeah, and then that loop keeps going, and then job losses and this and that, and it could have deflation, could have dire consequences on an economy if it's run long term.
Exactly. That's what happened in the Depression.
Correct.
So if you have deflation for a long enough period, you have a depression, not
Correct.
a recession, a depression.
Correct.
And it's for a very long period of time. Now, everything goes in cycles, so it will not last forever, but it's very painful. So now let's talk about inflation. So why would inflation be good over a long period of time? So this chart on the top panel up here, this is going back 34 years. This is the cumulative inflation. Okay. So you can actually see these colors are green, blue, and a few little reds.
Yep.
And you'll notice the red on this one right here coincides with the deflationary period down here.
Yep. So
there are some periods. This is 2015. We had a little bit, and over here, this is COVID. We had a little bit. But
it's funny. It's funny you bring this up, because Dan, I have a saying that I want people to keep hearing, and inflation is a feature, not a bug.
Yes, that's right.
If you understand that, you invest differently. You invest a certain way.
That's right. It's designed that way. It's designed into the economy.
Yep, it sure is.
You actually want you want inflation because that means you have growth. That means people are buying things this month because they know it's going to be too expensive next month.
Yeah.
Now you don't want that to be too much.
Yeah,
right?
you don't want 9%. Let's just take that off the table.
Devalues the dollar.
Correct.
But yes, but a 2% target is a reasonable target over a long period of time. Correct. Now, this chart shows cumulative inflation going back 34 years. So one of the things that I really can't stand when I hear politicians say inflation's coming down. No, inflation's not coming down. Inflation's never going to come down.
Yeah.
The rate of change of inflation is coming down.
Yeah, this is important. There's people talk about inflation and deflation. There's actually a third thing called disinflation.
Yes.
And that's what politicians
usually that's what we want. That's this right over here. Correct. Where you see peak inflation right here. And then it started coming down right there. That's disinflation.
Correct.
It hasn't gone below 0 yet, but it's not 9% anymore. So that's disinflation, not deflation.
Correct.
Now, interestingly, if you take the cumulative rate of inflation over 31 years, it's 108% over 31 years. All right. So over 31 years, whatever something costs $100 back here, it's $108.
No, it's $208.
I'm sorry, yeah, $216.
Or 16, yeah.
Right. So that on average is a 3.5% per year. And this is why the Fed will never get to that 2% target. It's a good target to shoot for, but they will never actually get to 2%. And if they do, it won't be for an extended period.
Okay. So this is an important thing. The Fed kind of silently changed their target, which actually not a lot of people talk about. Yeah. It's no longer 2%. It's not this kind of fixed number. Right. It's average inflation.
It's average over an extended period.
Which they never have defined. Is extended a quarter, a year, 10 years? Yeah. It's a very convenient metric not to define.
Exactly. But now let's take a look over here at the right. Just in the last 3 years, it's been 18%, which is 6% per year.
That's wild.
From 2021 till now, it's actually a little higher than that because it's actually gone up since this was made. So it's a little higher than 18% over 3 years. That's 6% a year. That's what we're in right now. That's what we want to come down. This near-term period.
Yep.
And not to be political, but that happens to be exactly when Biden's term started.
That's just mathematically true.
That's just mathematically true. Yep.
Yeah, you can't argue it.
Yep. That's right. So now let's take a look at something. I had a subscriber send me an email and I encourage people to do that.
Yeah.
And I will respond. Like the last video, we talked about the Hindenburg omen. So I sent him all the charts that I created and I put it on the website based on what he sent me. This is one that a guy sent me and said, hey, take a look at this. This is really interesting. This is a video that he sent. I'm not going to play the video, but it says a storm is coming and it's not inflation. Inflation or deflation. The point of this video was deflation is coming. In fact, deflation is right around the corner. We have a bigger chance of deflation right now than we do of inflation. And everyone's got it wrong. Everyone's talking about inflation and everyone's wrong. All right.
Okay.
That's the video. I think you know my stance on videos and clickbait, right?
Yep. I do.
So what would I do? Well, let's create a chart. And actually,
when in doubt, Dad creates a chart. I love it.
Right. Actually, what I did was I actually already had the chart, but what I did was I copied 2 of the screenshots out of this video. Okay. One that defines what inflation is, and one that defines what deflation is, according to this guy. Okay. And then what I did was I put it side by side with the actual chart. So the 3 things that he talks about are bonds, the dollar, and gold. Those are the three things that indicate whether we are in inflation or deflation. Okay. So I put it side by side with the actual chart of those three components. And it turns out, and when I replied to my friend, I said, did you realize when you watch this that this is 3 years old?
Whoops.
This is actually from 2021. So it gives us the benefit of actually looking to see what really happened. Okay. So here's the chart that I created right here. Can you see that?
Yep.
So I'll just explain this a little bit. On the left-hand side, these are his definitions. I screenshotted this right out of his video. So better indication of inflation: rising interest rates or falling bonds, a fall in the dollar, rise in foreign currencies, fall in the dollar, and rising gold prices. That's what inflation is. Deflation is a rise in bond prices, a rise in the US dollar, and a fall in gold prices. And this blue line right here, this arrow, is when the video was made. This was June of 2021. Got it. All right. And in that video, he put charts of each of those three things. He put charts of bonds, the dollar, and gold. Okay. And he drew trend lines on each one of those. Now, I put in the exact trend lines that he drew on his video. And I ended them right where the video was made, because that's where he ended his. Okay.
Sure. Yep.
So his point was, all right, so this is deflation, a rise in bond prices. So bonds are the red line right here. And he said, well, look, bonds have been falling for quite a while, and now they went down and came up and went down. It looks like they're getting ready to rise now. So it looks like the fall is over, and bonds are going to start to rise and go to the moon. All right. The US dollar, he said, so he was right here. He says, okay, we want to see the US dollar rising. Well, look, the US dollar has fallen. In fact, it made a double bottom here and it's fallen all the way down, and now it's broken through this trend line.
Yep.
Right. He says, okay, so the US dollar is rising. It actually did rise quite a bit. Third one is falling gold prices. That's gold, is this gold one up here. Okay. Gold has been falling and now it's going up, but and he made a point of saying it broke through this trend line, went all the way up here and came all the way back, and look how fast gold is falling now. So his point was, we have deflation coming big time ahead of us. But look what actually happened. Right? And the one at the bottom, the panel at the bottom, is the one that really shows it, I think, the best. So we have the dollar basically rising slightly, but basically doing nothing, right? We have bonds falling significantly since this blue line, since this video was made. Bonds are falling, and gold is rising significantly, right? So let's put those through three criteria, and where does it fall in these two things over here? Falls on inflation, not deflation.
Yep.
So he was wrong. And
yeah,
I always say it's great to, read all these different things that are out there, but back it up with what's really happening. Understand what's really happening. Don't just take
especially at a video that's 3 years old. You can actually go back and see how good the call was. And in this case,
yes,
not so good.
Yeah, not good at all.
Yeah.
He basically blew it. The question now is are all these going to reverse now? Well, I don't really think so. I think if the Fed cuts, I think bonds might rise some more, right? So bonds might go up. I don't think the dollar is going to do much. I think gold could go higher.
Sure.
But rising gold means it's inflation. Actually, if we have a combination of these, maybe that means stagflation.
There you go.
Right.
There you go. Back to stagflation. It's looking more and more likely. It really is.
Right. Yeah. But again, we're not going to know if we're in stagflation.
Oh, for time.
For
yeah.
A good 6 months before you can even say it's stagflation.
Correct.
Because we could easily go into stagflation on the way to.
Correct. A real recession. Yeah.
Well, I think we'll get a real recession, I don't think we're going to get it until next year. I don't think we
Yep.
are in a recession.
Right.
I think that there might be some parts of the economy that are recessionary
Oh,
to
for
a
sure.
degree,
Yep.
but I don't think we are in a recession. And
Very
I don't
cool.
think we're going to have one until next year sometime. I mean, if
Right.
you look at industrials imply, production and manufacturing, right?
Mhm.
Well, industrials over the last 2.5 years have been doing great.
Yep.
They've come down a little bit recently, but they are still within this trend up here. So industrials are still doing well. Materials, which is basically gold and silver and aluminum and things like that, materials have been doing well.
Mhm.
So there isn't anything in here that says that the economy is ready to roll over or go into a recession. But we'll keep watching it, and it'll be important to see what the jobs number is next week. That I think will be the first.
Well, let's talk about it. Let's wrap it up. We're running a little late, but let's talk about that
Okay.
jobs number. It comes out Friday. I think expectations are 175,000 or 178, something like that. 3.9 is the expected unemployment rate.
Is it okay? So I didn't know when I did my newsletter. They actually didn't have a
Yeah, I got that
forecast.
this morning.
Yeah,
I got that this
okay.
morning.
Yeah, 3.9. Then it would be flat if that came in 3.9.
Yep.
Down here,
Yep.
175 would be flat too.
Yeah, so I think it's maybe 178 because one of those numbers. But I got it this morning, 178. So basically flat. And
All right.
what do you think?
Do you want to do an over under on that on the
Sure.
3.9 on the 3.9?
I
don't care. I don't care that much about the payroll number. It's especially in an election year, it's going to vary significantly. But
I do not think we'll see 4%. I think we hit 3.9.
Okay. Just for fun, I'll take the over. Just for fun.
Well, let's play that out.
I think we'll hit 3.9 too. But
well, let's just play the other side. Let's say we pop a 4 Friday morning.
Right.
Here's a crazy thing. I actually think we pop 4%, the market might rip higher. Bad news is good news.
Yeah. That's right. Because the Fed might cut that. Yeah.
That's what I think the market will see. And again, I'm not going to say the market's right. I think you heard the Fed say, data dependent, blah, blah, blah. But I'm just going to take a wild guess. 4% print, 5:30 Pacific, Friday morning, the market rips, at least at the open, rips higher.
Right. Yeah, I don't disagree with that. What if it hits 4.1?
Whoa. Probably the same answer. But again, I want to be clear.
It'll
only
still,
at the open. I don't know they don't.
No, I'm sorry. What if it hits 3.7?
Oh, 3.7. If it hit 3.7, the market's going down.
Right.
Absolutely.
Yeah, 4.1 would actually probably be better for the market because then the Fed could cut in June.
Yeah.
Could cut in
June. Come on. June.
Well, I mean, if
you might get a July cut. There's no June cut coming.
Yeah, I don't think there'll be a cut until December. I think it'll be one cut and it'll be December.
Yeah, I'm going to stick with my November, but yeah, it could be December.
Right. But yeah, I mean, it's going to be touching up against that SOM roll against the 4.2.
It's coming. It's coming. Dan, where can people find you? We have great conversations each week.
Breakpointtrading.net. Click on the box to get the free newsletter. And at the bottom of the page, if you want to register and get an alert that the newsletter's out, you can do that too.
Very cool, Dan. You're amazing, man. Talk to you next week.
All right. Take care.
Bye.